We've got some news.
Well,
We're going to go to literally
Warner
right
Brothers,
now.
the shares are halted. Warner Brothers Discovery shares are halted. So I don't know. It could.
I think we are here.
It's out.
I think we've been waiting for it.
Press release is out.
Press release is out. And let's explain to the public what's happening here.
Not the biggest secret in the world that Netflix.
Netflix is the winner.
Is the winner, and the deal's done apparently at this point. And the details will be forthcoming, and we'll see whether regulatory muster becomes a problem. I know that at least Warner Brothers is halted at this point. I figure Netflix probably is at this point. Let's see. Following, it will be after, obviously, the separation of some of the cable.
Well, you have two deals going on here. So you have
that one happened.
Netflix is going to be buying the streaming business.
$27.75 a share. It says cash and stock for
$27.75. And most importantly, on the regulatory side of this deal, if you're looking, the breakup fee is $5.8 billion.
More than.
So people have been discussing how regulators would think about this transaction.
Right. Equity value $72 billion. Total enterprise value, $82.7 billion at this point.
That's with the debt piece of it.
That's with the debt.
Right.
It is one of the most storied, Warner Brothers, one of the most storied studios and entities in Hollywood, obviously. And it culminates, I guess, with Zaslav able to deliver, I guess you would say, to shareholders at this point of Warner Brothers, a heck of a lot better than $12. Or $11 a share.
Given where it had fallen to.
Given where it had fallen to.
The big question on the regulatory side is going to be, the argument effectively here is that if you look at the Paramount transaction, that would have effectively taken out a studio, right? In this case, you're not taking out a studio. That's a big part of the argument. The other argument that Netflix is effectively going to have to make, and Time Warner is going to have to make, or I should say Warner Brothers is going to have to make effectively, is to argue that it's not just looking at the marketplace in the context of streaming itself, but to look at it in the context of time spent online, eyeballs and the like. You're going to have to effectively include YouTube viewing and Amazon Prime and so many others, so that you're not just looking at the paid streaming business. What you looking at there?
I'm looking at the cash component is $23.25. $23.25, $4.50 in the shares of Netflix common stock. That comes up to 27.75. There's collars on the shares. This is going to be a complex.
It's going to be a complex deal. And by the way, this is going to be in the regulatory mix for a long time.
It could close in a year and a half. That's what I think they would hope that it's able to close. Mm-hmm. Does Zaslav run Warner Brothers, the studio,
I'm trying to look
and
through
HBO
this to find
Max?
out. What I also don't know is, and this is where the next piece of this comes. Does Paramount try to go hostile? Is there some other element of this that could happen? I don't know. Wow. What do you think regulators do? Jason Kilar, who ran, I should say, Hulu for a very long time, came out last night. I don't know if you saw the quote. He said, if I was tasked with doing this, I cannot think of a more effective way to reduce competition in Hollywood than selling WBD to Netflix. So there's going to be a lot of consternation in Hollywood. By the way, there would have been consternation whether it was sold to Paramount or to Netflix, but clearly there's going to be lots of disagreement about, who should be the owner effectively of this asset. But it does appear that Netflix is now going to be the owner, or at least going to attempt to be the owner, and that Warner Brothers Discovery's board has decided to take that bet and to take that bid.
Hey, guys, it's probably worth taking a look at shares of Netflix just longer term on this, because it's a market cap of about $438 billion. It's the media company that has been the darling of the street. It's off its 52-week high, which was $134.12. 103.22 is where it closed yesterday. But you're still talking about, if you look over the last 5 years or even the history of the stock, that was an all-time high when it was sitting at those levels. It has done very well, particularly relative to some of the other media companies, and you wonder what wrapping this in.
We should point out that they get $2 also approximately from the spinoff of the linear business. So if you want to actually add in it, it might actually
add that back in.
come to 29 to $30 in terms of what.
Yeah, no, and this is what, look, David had
Yeah.
said, David Zaslav had said from the beginning he wanted $30 a share.
And it looks like
this is
basically
effectively,
close to
arguably a
that.
$30 a deal share,
Yeah.
if you believe that the spinoff ultimately captures that.
Captures the $2.
That $2. Now, some of the arbitrageurs are going to start to do a time value of money on the Netflix portion of this
Right.
transaction.
How long this gets locked up.
Can we say,
Right.
how nasty could it get? Because it got nasty already, the letter, where they actually, they didn't, I don't think
Paramount?
they mentioned Zaslav by name, but they said that management
Look,
is.
just in fairness, they sent a letter just literally 24 hours ago to the board. They said that Netflix's dominance in streaming and Comcast, which is the parent company of this network, which had been bidding for it as well, as presence as a leading broadband and MVP player, present unique and serious antitrust concerns that guarantee a long
they
and
actually said that
expensive review process and imperil closing either deal. Paramount is the easier path, and its outcome is assured, they were arguing. And then we've discussed this idea that the Trump administration was, closer to or willing to do this. Let's get Faber on the phone because he's calling in right now. Hey, David?
Yeah, hey, Andrew.
Tell us what you know.
Well, you guys obviously have the terms, I guess, at this point. And listen, I mean, the price itself, you have to just step back for a second and consider. Because $27.75, $23.50 of it in cash, and then the rest in stock that's going to be collared is quite a number. And remember, it's for the studio and streaming business. So in addition, because they've reversed the split, there will be a remain co that will trade publicly called Global Networks, made up of all the linear cable networks of Warner Brothers Discovery. That will also have a value. Maybe it's $2.50, maybe it's as much as $4. Put it all together, and you do end up with a value of at least, let's call it, over $30 a share. And don't forget, guys, for a stock that was trading at about 11 or 12 bucks before all this started. So it's an enormous premium that Netflix is willing to pay here. Much of it, as we said yesterday, as I reported, 85% of it in cash. And as you were just talking, though, and has come up numerous times in my reporting, of course, as well, is the question of antitrust and whether, in fact, this is going to be something that can get past the regulators and, of course, Donald Trump as well, given you are putting together the number 1 and number 4 streaming companies in the world. And that will continue to be a key question. There is a $5.8 billion reverse break fee, meaning that if Netflix is unable to get to the finish line, $5.8 billion will go to Warner Brothers Discovery. But many shareholders will argue that's not enough to compensate for what could be a very long process that could still end in them not owning the company. We just don't know. We'll have to wait and see. But a stunning outcome, Netflix clearly showing that it was very much determined to own this business. And again, guys, I'll defer to you as well and your thoughts. But, Netflix pursuing this so aggressively, you wonder what of its shareholders will question whether, in fact, what it was seeing that made it want to go down this road, given its multiple to earnings, has been the envy of the media business for many years. Is it putting that multiple at risk?
Right. So, David, a couple of things. As I was talking to folks around this transaction yesterday, we've heard and there's been reporting that Ted Sarandos had been down to see the president in the White House, that they felt, some assurance that they could actually move ahead with this deal. In part, by the way, my understanding is because CNN and the linear channels are not part of this, and that potentially that might allow, or this administration might look more favorably on this deal because it's not thinking about some of those linear businesses. I don't know if you think that's true, and whether you think that the real impetus for this is that actually so much of the library programming that Warner Brothers has lives or has been sold to Netflix, and they wouldn't have access to that in the future, and the idea that they could actually take down material costs, given that they would obviously now own HBO.
I think that's all true. I think your reporting on Sarandos and the president is important because, again, that goes to that key question. And as we know, the president ends up being a key decision maker in so many of these kinds of things. There had been a perception, of course, that Paramount had a much easier path, and I said this many times. First of all, given they were paying a number for the entire company, and secondly, but not less important, that they had a very strong relationship, was believed, Larry Ellison, with the president, and therefore would have an easier go on the antitrust front. When it comes to what Netflix gets here, you're absolutely right. The library is certainly one of the key things. They no longer measure this company in terms of subscriber growth, right? It's simply time spent. How much time is our audience with us? And with the ad business as well, an important component of their growth plan, that library is going to be key, and franchises they're going to be able to bring over, and not to mention the HBO shows and things like Game of Thrones and everything else. I continue, though, but you've got to remember, Andrew, if they're no longer buying that programming, so to speak, they're keeping it for themselves, it's sort of a wash. And,
Right.
There will be a question as to whether or not that's really going to contribute to any real growth for the company. There may have been a significant threat if Paramount in particular had bought the company that they would no longer have access to certain programming that obviously is very important. And as you guys well know, they don't own a lot of their own IP, which is something David Zaslav will tell you so many times, and that's a key consideration one would have to think for them as well.
Why didn't Netflix just buy this instead
Faber.
of Discovery a couple of years ago? Instead of basically getting everything but Discovery, sort of, right? And then,
I don't know. Why didn't Paramount buy it, Joe? Like when they, instead of been, or David Ellison and Larry Ellison, why didn't they just step up and try to buy this thing when it was $8?
And who's going to pick over
Because
the
I think it speaks to the changes.
assets?
Yeah. That's a good question. Look, one thing I think this does kind of speak to, though, is that constant fluctuation in what the market values. Do they value the enviable margins that David was pointing out that Netflix has before, or is it back to content as king, and there's only so many of these content places to go around? It's probably noteworthy that Paramount's Skydance shares, at least until just a moment ago, were off by even more than Netflix, the idea that they might miss out on this asset. So they're down by 2.33%. That's not a concern about overpaying that's reflected there. That's a concern about there's only so many of these assets to go around, and you have to have that content and you have to get bigger. So I think it's that constant battle that we've seen play out over the last several years in the market over what investors are going to value at any given point.
Becky, as well, I mean, you're right. And I wonder whether this will usher in another round of consolidation. Because, to your point, Paramount was looking at the possibility of $6 billion in synergies from putting these businesses together. Those are huge, obviously, cost synergies. And giving it the scale at its streaming company, Paramount Plus, to really compete globally. And so, you have to wonder, they've done better than many had anticipated, at least the last quarter, in terms of where they came in on EBITDA versus, of course, a promise that was far above that some time back. But that said, the opportunity here or the miss is a significant one for Paramount. They competed very aggressively here. As you know, they started all this off. They made 5 bids. Remember, 3, of course, before the auction began, and then 2 more. I think they were contemplating, I have to find out from reporting, going as high as the high 20s, maybe even to $30 a share. Much of it financed with Larry Ellison's fortune. And yet the choice here, apparently from Warner Brothers, was to go with Netflix, despite, again, what we will come back to numerous times, being that risk in terms of what the regulatory front will look like for the company.